Welcome, Business 20 students. This is Mr. Doucette, and I'm going to work out some problems from chapter 17 real quick here for you. Sorry, I'm so casual. Like I said in my last video, I spent 4 or 5 attempts now trying to get this all to work, and finally had a moment, so I just did it, even though I wasn't quite dressed to the right kind of business attire. But I did want to give you a video as I promised I would. So I'm going to work through some problems on chapter 17 with you, which is on depreciation. Now, depreciation, if you're not familiar with that, basically is when you buy an asset for your business. You buy it and it goes into your asset portion of your financial statements, and then you need to depreciate that asset because it doesn't hold its value. And so you don't depreciate it all at once. You do it over the course of a number of years. That way you get the greatest benefit out of that purchase as you depreciate it, and it works well on your taxes and things like that because it shows your assets declining in that sense, so you pay less taxes. So anyway, that's why you want to depreciate something, and there's different ways of depreciating an item, and we're going to be looking at 2 of those, I believe. We're going to look at the straight line method, and then we're also going to be looking at the not the declining balance, although I might do that. We're also going to look at the units of production method. So the straight line method is pretty simple as far as the steps that you go through. So you determine the total cost of your item, then you minus the salvage value. Salvage value is what you believe it'll be worth at the end of its useful life. So, if you buy a truck for $25,000 and then after 5 years you've used it for your business, you might say, well, now it's only worth $5,000, or maybe it's only worth $3,000. So that would be your salvaged value. That's what it's worth at the end of your depreciation period. And of course, you'd need to subtract the salvage value from the total cost. So again, if it was $25,000, you'd minus the, say, $5,000. So now you have $20,000, and then you want to depreciate that $20,000 over how many years, or how many years that you think it should be depreciated. So let's just say you go, well, I want to depreciate it over 5 years. So you would take the total depreciation, divide it by 5 years. Total depreciation is, again, total cost minus salvage value. And then you'd divide that by 5 years, and then that would give you your annual depreciation amount. So it's pretty simple, the straight line method. I'll work out a problem here down the bottom. It says Wildflower Bakery purchased a bread oven for $125,000. I'm going to go ahead and write this on my screen, and then I'll share it with you. $125,000. Shipping charges were $1,000. I'm going to put that off to the side, $150. And then $750 as well for installation. So those are going to be added to the cost. And then it's expected to last 5 years. And then it says that it's going to have a trade-in value, which would be the same thing as a salvage value of $5,000. Okay, so that's the scenario. It says prepare a depreciation schedule for its useful life. And they're looking for kind of a longer term, and I'll just go through 1 month with you, and then we'll come back to it. So let me share my iPad with you so that I can show you what I got. All right, so there's the terms. Can't see because my ugly face is in the way. So you have a $125,000 asset. There's a shipping cost and installation cost of another $1,150 and $750 and all the rest. So typically what you do on these problems is you add all that up. So you add the $125,000 plus the $1,150 plus the $750. So that's all going to equal. Let me do the calculator here. Oops, it's in the way. Sorry. So 125 plus 1150 plus 750 equals, so 126,900, and then you're going to minus the 5,000 from that because that's your residual that you'll have left over. So that's going to come out to 121,900, and then it said 5 years, so we're going to divide that by 5, right? So let's minus 5,000. That's the salvage value, and then we're going to divide that by 5. So that's 24,380 a year that you're going to depreciate. that item. So it tells you to create a depreciation schedule. And how you do that, I'll show you in just a second. All right, so I started to make here a depreciation schedule for this particular asset. And if you notice, I start with year and then I put annual depreciation. That's how much every year it's going to depreciate. And then I put accumulated depreciation. And then I took book value. Book value is what your income statement or your balance sheet is saying that that asset is worth. But we're going to depreciate that asset all the way down to where it's only $5,000 in your book. And so how you do that, of course, is you take it year by year. And what they want you to do in this problem is to actually do the math on it. So if year one my annual depreciation is 24,380 and my accumulated depreciation is not going to be any different because that's all I've appreciated it so far. So I'm going to put that here, and then I'm going to minus that from 126.9 for year one's depreciation. So 126.9 minus 24,380. So the end of the first year, my book value is 102,520, right? Then year two, I'm going to depreciate it again, the same amount. However, this time I'm going to double. Now my accumulated depreciation is that times two, right? So 24. Anyway, and then the next year, same thing. I have another year's worth of depreciation. I accumulated depreciation is just adding two of those together because you're going to see as you go down the accumulation depreciation line that the total appreciation will be at the bottom right before the last year. And so I'm going to do the same thing. I'm going to subtract. I'm going to take my 102,580 and I'm going to minus another year's worth of depreciation. Comes out to 78,200. So you'll keep doing all that each year. So then you go to year three, do the same thing. And then you're going to add another, you're going to take the 48,780 and add another 2430 to it. So let's just do that real quick. 48,760 plus 24,380. So now you have 73,000. So that's your total accumulated depreciation. Right? And then you're going to subtract another. So now your new book value is 53,820. And anyway, you'll do that all the way down to the end until you get to, it'll be 121,900 right here as accumulated depreciation. And each one of these is going to be 24,380. And so that's how you fill it out. And all you're doing is showing each value all the way down, your book value all the way down. So that's how you solve those straight line depreciation problems. I'll move on to the next one. All right, the next method that we're going to look at is called units of production. And rather than dividing it by the number of years that you might think the item is useful for, you might just do it by how much you use it. So for instance, if you bought a brand new truck to purchase for your business use, you could say, well, it's going to depreciate over 5 years, or you could say, well, maybe 1 year I might not hardly use it, so why should I depreciate it that much? Or B, you might say I used it a lot, I should depreciate it a little bit more. So this is a way of depreciating equipment that's a little more variable year by year, depending on how much you use it. That's what we call it, units of production. So basically how it works is you have your, first and foremost, you have your, you want to find out how much your depreciation is per unit. So let's just make the depreciation by miles. We'll do it by miles. So if we're going to say the truck that we bought depreciates over 200,000 miles, that's the useful life of it. So how much per mile then are we going to get? So we're going to take our cost. So let's just say we spent 60,000 for the truck, and then we're going to say it's worth 5,000 at the end of the useful life when it's got 200,000 miles on it. And we're going to divide that by the 200,000 miles. So we're going to find out how much per mile we depreciate the vehicle. So we would take our 60,000. I could have just did it the other way. Minus 5,000 divided by 200,000 equals. I didn't do it right. Hold on. Let's just do 55,000 divided by 200,000. All right, so 0.275 per mile. So basically, every mile I drive that vehicle, it's going to be 28 cents, 2.75 cents or 2.8 cents to drive it. So if in year one, let's just say I drove the truck 6,000 miles, so I'm going to multiply that by 0.275. And that's going to tell me how much to depreciate it at the end of year one. So 6,000 times 0.275 equals, so that would be 1650 for year one, number one. If year number two, let's just say I drove it 29,000 miles. So 29,000 times 0.275 equals 79.75. So year one, I didn't drive it that much, and I depreciated it in my books by 1650. In year two, I drove it a little bit more. I went I went 29,000 miles, so that was $7,975 worth of depreciation. So you just keep going. So it could be 10 years, depending on how long it takes to get to 200,000, or to where you have 5,000 left, or it could be 4 years, depending on how much you drive. But you're basically doing it by each mile, and 200,000 miles is your useful life. So you could do it with time, you can do it with mileage, you can do it by different criteria, but that's basically how you do it. It's pretty simple as well. So those are the only two methods I'm going to have you do. If for some reason you get some of the years, or you get the other one's the declining balance method, they're both also very popular as well. But I'm not going to give you any questions on that. I'm just going to give you the questions on these two. If for some reason you come across a problem like that, go ahead and give it your best shot, but I'll give you credit for it anyway, if you do well or not. So anyway, that's it for this video. Hopefully that's helpful, and we'll see you all soon. Have a great day.